Stocks gained with mid-caps leading the bounce after the big sell-off on Monday. Utilities and metals are the big gainers, even as IT and FMCG drag.
Rupee recovers a bit in early trade as dollar index falls from Monday's high, but demand for dollars pulls back the Indian currency to fresh lows. India's December CPI inflation comes in lower than expected at 5.2%, but bond yields continue to inch up as the street fears the RBI may skip a rate cut in February.
HCL Tech sees its biggest single-day drop in nearly a decade on profit booking following a big run-up after the quarterly results were mostly in line with expectations, but the company tempers its outlook.
JSW Energy gains on winning the bid under the IBC process to acquire the 3.6 gigawatt Mahanadi Power. This resolution is also a positive for large lenders to the ailing utility, including PFC and REC.
And soon after, Avenue Supermarts announced a change of guard at its helm. United Spirits has also said that its CEO Hina Nagarajan will move to a role at Diageo, with Pepsi veteran Praveen Someshwar set to take charge.
Good afternoon, you're watching us here on Halftime Report. I'm Mangalam Malu, with me Hormaz Fatakia. After a big sell-off yesterday, today is some respite. The Nifty is holding with gains of almost 102. Still off about 90 points from today's high, but nothing really to worry about. The broader markets, after a brutal fall in yesterday's trading session, the mid-cap index is now sitting with a gain of almost 2%. Still negative for the week, mind you. It's seen a sharp fall of almost 7-8% in this month so far itself. But the bulls would feel happy that there is some respite after the big fall. The banking index is the one which is leading the charge today, as the IT index has taken a backseat after the weak numbers that we've seen from HCL Tech itself. So the Nifty Bank holding with gains of almost 550 points. Hi, good afternoon, Hormaz.
Good afternoon, Mangalam. And it's a relief, if you can call it that. You can't say a relief rally, but you can say a relief nonetheless after watching red all across your screens on Monday. And the IT index, as you mentioned, led by HCL Tech, is taking a bit of a backseat in today's session. The broader markets, the mid-cap index has recovered half of what it lost yesterday. It's up 1,000 points now, was down 2,000 yesterday. The small-cap index too, seeing a bit of a rebound for 1.75% higher. So good going for the broader markets as of now. The last Tuesday was when we had seen a bit of a recovery from the lows, and then we saw a bit of a sell-off. So the bulls would be hopeful that there is some recovery that continues. And there you can see the WPI numbers flashing on your screen. The wholesale inflation coming in at 2.37 compared to 1.89 in the month of November. So the December figure at 2.37. Mind you, the retail inflation numbers that were reported yesterday were better than expectations. They were down on a month-on-month basis. The wholesale number, though, has come in higher on a month-on-month basis. The food inflation continues to remain stagnant. There is no change on a month-on-month basis. Still continues to remain around that 8.9% figure. So that will be a key monitorable to watch out for as to what the RBI does next when it comes to its next rating action. Fuel and power inflation now at a negative 3.8 compared to a negative 5.8 on a month-on-month basis as well. So WPI numbers higher on a month-on-month basis.
Higher on a month-on-month basis, led by two things in particular. One is fuel and power, where the deflation has come off a bit, as we've seen that in the kind of spike that we've seen in crude prices as well. And the second part is primary articles. That too, the inflation has come in at 6.02% versus 5.49% in the month of the previous month itself. So we'll keep an eye out on that. And apart from that, we did see the food inflation stay sticky. Aditi Nayar joins in. She's the chief economist at ICRA. Aditi, of the CPI that came by yesterday and the WPI that you're seeing right now, what is your sense?
Well, certainly today's WPI numbers have come in a little lower than we were expecting, whereas yesterday it was the reverse. The CPI was a little bit higher than what we had forecast for the month of December. Now, looking ahead, my sense is that the WPI is going to continue to climb, whereas the CPI will hopefully continue to moderate. So the directions will be quite different for these two indices in the near term, and a little bit of kind of trend towards convergence that we would expect between the CPI and the WPI going ahead. Food prices in the current month are quite benign, particularly for vegetables, so that's good news. At least one of the things that has been keeping our CPI inflation very high, that pressure will be coming off. And the Rabi sowing data isn't looking too bad, so that's a positive as well. Big concern, of course, going ahead, particularly for the WPI inflation, maybe a little less so for the CPI inflation, is what happens to the rupee, as all analysts and economists are, looking at the kind of movement that we've seen in the last few months and where the rupee will settle going ahead.
Okay, hi Aditi. The WPI inflation is quite a benign number at 1.89. Even the CNBC-TV18 poll was 2.4%. So it's like lower than the previous year, and it's 2.37. Okay,
1.89 is the previous.
Then it's pretty close to the poll. Okay. That removes at least the fear that there could be deflation in certain areas. That was what I was going to ask Aditi. Okay, that makes it a little different. But do you think going forward there can be a kind of a deflationary bias, given that it is expected that China will continue to be a deflationary force? They themselves are not growing enough, and they are a huge exporting country ready to undercut any price. So do you expect WPI is going to remain a deflationary force for now and for the rest of 2025?
So Lata, certainly a couple of things that I do believe WPI inflation, even in FY26, for instance, is going to be lower than the CPI inflation. So that will continue from both points of view, that the CPI reflects more of domestic factors, whereas the WPI reflects more of global traded factors. And of course, the fact that the weight of food is much higher in the CPI than in the WPI, and that's been a source of concern for a long time now. Beyond that, I think a couple of factors that will keep us worried about the WPI. One is where crude oil is going to settle with all of the global uncertainty. And secondly, of course, where the INR itself is going to settle. Other commodity prices, definitely your point is very valid that, the China factor is going to be the big driver for all other commodity prices other than crude oil. Of course, demand from China is very important for.
My short point is that what is your average expectation of WPI for next year? Have you already calculated that, or do you have a view on whether it will be lower? Because CPI, clearly the RBI's forecast is it's averaging 4.3% next year compared to 4.8% in FY25. What's the delta for WPI, higher, lower?
So we're at around 4.2% for CPI for next year. WPI, highly volatile, but I would expect it to be maybe in the 3 to 3.5% range for next year.
Okay, so that will have a bearing on what kind of a nominal GDP the budget can look at, right? If growth is also going to be sub 6.5 and inflation also is going to be, as weak as you're saying, under 3%, then you can't have a very good nominal GDP when you forecast on February 1st. Is that right?
So 3 to 3.5 for WPI and about
3 to 3.5. Okay.
Yeah.
Okay, so
4.2% for CPI. So the average for inflation would be still between 3.5 and 3.7%.
Okay, then just more a final question for the market. With this WPI already in 2.37, these are the last inflation numbers the Reserve Bank is going to get when it goes to making policy on February 7th. What's the expectation?
Lata, this is becoming really a very complicated policy decision in my mind. We've got inflation where things are looking a little bit more comfortable on the CPI side. We've got growth numbers where Q3 was not as bad as Q2. That's what all the high frequencies are telling us. And then we've got an exchange rate where we've seen the kind of movements in the last couple of days, which are a little unsettling. And what is going to be the impact of that on the inflation and on the growth dynamics? And how does each MPC member sort of, what is their balance for inflation and growth and the exchange rate and the overall policy framework? My sense is that we can't rule out a rate cut in February itself, but the probability of that is going down quite rapidly in my mind. We, of course, will also have the budget before the next policy decision, and that will be another big thing for monetary policy to look at before taking the decision.
Okay, so you're saying that it could go either ways.
Yeah.
Okay, all right, we'll leave it at that. The key takeaway from Aditi is that it's going to be a benign WPI. I mean, maybe 3% next year also. Going by the trend, it looks like even that stuff, and especially the geopolitics, is pointing towards lower, several commodity prices. Well, I can understand the ambivalence in terms of what to expect from the governor. The key point that Shaktikanta left us with is that he wants to see CPI aligned to the 4%, which more like I want to see 4% on the table before I cut rates. It's quite possible that the new governor can tweak that and say that I can see 4% 12 months down the line. It takes interest rates that much long to work their way into the market. So I'm comfortable cutting now. That position can very clearly be taken, and a new governor does bring his own narrative. There will also be a new deputy governor. Interviews are going on, and we'll probably get the announcement tomorrow or day after.
And before that, we'll have the union budget as well. So what happens through the fisc is something that will have an impact on what the monetary policy does as well.
Going by the behavior of the government, they're very, very conservative about the fisc. So I don't think that 4.5 is... yesterday's town hall, the key takeaway was no, 4.5 will not be altered. So assuming that is a constant, the chance of whether there will be a cut, all the data is already in place. Inflation, everything is known. So from now to February, you're not going to be any the wiser. It's only the currency which can throw a googly. My sense is that Trump's announcements will be in the first week. We will have relative calm in February. So a rate cut is not to be ruled out at this juncture.
Let's hope for a relative calm in February.
Well, to cut or not to cut is the big question. Well, I guess we'll know the answer in February from the new RBI Governor. Lata, thank you for joining in on that segment for the WPI. Time for a short break. Back to the markets on the other side. Stay tuned. Welcome back. Still 100 points higher on the Nifty, 90 points higher. I'd like to bite my tongue and say that this might be an unconvincing bounce because we saw a similar one last Tuesday and we all know what happened after that. But still holding on to gains, and that's the more important thing. Holding on above that 23,150 mark as of now is the Nifty. But the casualty of the day, though, is HCL Tech after its results. And that 9% fall that you see on the screen is the biggest single day drop that the stock has seen in a decade. And that comes on the back of its third quarter results. Rima is here to give us a highlight from what were the results and what brokerages are saying for HCL Tech. Rima.
Well, you know what's causing the stock to fall is the positioning that investors went into going into HCL Tech's numbers. Last year, HCL Tech rallied 30%, while its peers say TCS was up only about 9%. HCL Tech's PE re-rated by 20%, and by the end of it, HCL Tech was actually trading at a premium to TCS and Infosys. So that's the reason why it went in with very high expectations, and the numbers failed to meet that. So the numbers in Q3 were a miss on the company's top line. The revenue growth was at 3.8%, lower than consensus expectations of 4.1%. Margins were in line, so no beat over there. Q4 guidance, the implied guidance on the top line, because the company has held on to its, given the tweaks to the full year revenue guidance, the Q4 implied guidance is minus 1.3 to plus 0.6%. So no acceleration seen in Q4 growth. The company also said that Q4 margins will be slightly lower than Q3 margins. Also remember, the company has a lower exposure to BFS, Banking and Financial Services vertical, which is where we've seen the maximum pickup in discretionary spending. Brokerages, now Kotak has cut the FY25 to FY27 dollar revenue estimates by 1 to 4%. They say the stock trades at full valuations. They've got a reduced call. CLSA, Jefferies and Morgan Stanley, all of them have an equal weight or a hold call, again on the back of the re-rating that we've seen and the valuations HCL Tech is trading at. Nomura, though, is still bullish, buy call with a target price of 2,000 rupees. So in a nutshell, the numbers failed to excite the street. There were a few misses in terms of the fact that the company didn't raise the upper end of the revenue guidance. Q3 was a miss on the top line, and plus full valuations and the recent run up in the stock and outperformance. All these are reasons why the stock is under severe pressure today.
Take that point, Rima. In fact, we also spoke with the management of the company, asked them about the fourth quarter expectations on growth and margin as well. discretionary demand and deal outlook too. So let's hear out the excerpts of that conversation that we had with the management of HCL Tech.
I think our momentum across all the verticals is continuing to pick up. And there will be some impact because of a large program coming to an end in the retail CPG segment, where we had a 14% sequential growth last quarter. Now, to backfill that project with new projects, it will take some time because some of the deal wins have happened towards the end of the December quarter. So that pickup will happen towards the second half of the March quarter, and that will continue into the Q1 of next year. I think the way you should interpret this is, every vertical has some dynamics that plays into every quarter, but is the new additions adequate enough to kind of offset some of those reductions is what we should see. We are quite positive of an all-round growth in Q4.
Impact is going to be somewhere between 50 to 60 basis point. Yes, the margins in next quarter are going to be slightly lower than Q3 because Q3 has an impact of seasonality of the software. That's the only variation I can see. Otherwise, rest I think it should be fine.
I think there is a good momentum in a number of small deals, and that has a potential to convert to revenue quicker. Some of the large deals conversions continue to be a little slow, but we expect that to pick up with some of the uncertainties behind us. We think the large deal momentum should come back in this quarter and maybe Q1 of the next financial year. All verticals, it looks good. And maybe a little bit in energy and utility, some softness, but financial services is good. Tech vertical is looking good. Telecom also, there is a lot of efficiency-led improvements that clients are looking for. That is also creating good demand.
The management of HCL Tech after its third quarter results, the street though remains unconvinced about its potential considering full valuations. Time to take a short break, but before that, introducing Growth Code, a special initiative by Grow and CNBC-TV18 to further empower retail investors and traders. Renowned investors and professional traders convened at Grow's Trading Right event on the 9th of November last year, where they shared valuable strategies. Here's a snippet of what Aditi Nayar, who's the co-founder of Fintoric Capital, had to say about the risks of trading penny options. Listen in.
पेनी ऑप्शंस का जो प्रोबेबिलिटी होता है जीतने का वो बहुत ज़्यादा होता है 99% से ज़्यादा प्रोबेबिलिटी होता है उसके जीतने का बट इसके साथ उसके इतने सारे नेगेटिव्स आते हैं कि उसमें जो सबसे पहला है कि उसका रिवॉर्ड बहुत कम है आपको मिल सिर्फ ₹1 रहा है अगर आप यही काम ₹100 वाला ऑप्शन बेच के करोगे और फिर वहाँ पे आप रखते हो कि मैं ₹10 का टारगेट रखता हूँ तो वहाँ आपका विन रेशियो भले ही कम हो जाता है बट आपका साइज 10x है दूसरा कि अगर आप पेनी ऑप्शंस देखो आप कहते हो कि मैं तो ₹1 के ₹2 में ही काट देता हूं तो अगर आप उस ऑप्शन को देखोगे उसका नेचर भी थोड़ा सा डिफरेंट होता है तो जैसे ₹1 का ऑप्शन है मार्केट ऊपर जा रहा है आपने पुट राइट करी है मार्केट ऊपर जा रहा है वो फिर भी वो ₹2 हो जाएगा अननेसेसरी हो सकता है कोई ऊपर जा रहा हो तो कोई उस हेजेस को खरीद रहा हो तो आपका वहां पे एसएल हो जाएगा तो जब आप उसको 1:2 देखते हो उसकी जो प्रोबेबिलिटी है 1:2 होने की वो बहुत ज्यादा हाई है कंपेयर टू ₹100 का ऑप्शन बेचते हो उसके ₹200 की होने की तो इस तरह से आपका वहां पे जो प्रोबेबिलिटी ऑफ विन है वो भी कम हो जाता है
Welcome back. The market's recovery seems to be getting sold into, the Nifty Bank, which at one point was, at close to 48,800 is now back below 48,500. Not only is it the Nifty Bank, the FMCG stocks, which were seeing some bit of outperformance over the last couple of trading sessions, have come in for selling again. Titan, case in point, the intraday chart comes up for you, down about 3.5% from the lows, currently at the low point of trade. Remember it being in the green at, most of the first half of trade. And from the moment it slipped into the reds, only gone lower, currently at the lowest end of the range. HUL and Britannia are the other ones which are still in the red. HUL down about 2.2% as well at the low point too. But Bernstein has actually introduced some new stocks in its model portfolio 11 new stocks have been introduced, whereas 4 have been removed. Nimesh tells us more about this addition and deletion of that list. Nimesh.
Yes, Mangalam. So as you rightly pointed out, Bunsen has put out their model portfolio changes. They have actually identified 11 bottom-up ideas for 25. Now, in terms of additions, they've added 5 stocks, which includes IndusInd Bank, Coforge, Bharti Airtel, Adani Ports, as well as Jubilant FoodWorks. The deletions are Reliance, HDFC Bank, REC, and Zomato. They've made some changes to the sectors as well. They've increased their allocation to IT services and to some select consumer sectors as well. Within the consumer sector, while they retain DMart, they've added Jubilant FoodWorks and they've removed Zomato. So that's a change in the consumer basket. In the industrials, they've reintroduced Adani Ports after the sharp correction in the last few weeks. Similar is the case in telecom as well. They've reintroduced Bharti Airtel after the recent correction there. Within the financials, that's interesting. While they've retained ICICI Bank, they've added IndusInd Bank into the model portfolio, largely on back of the sharp correction that they've seen in IndusInd Bank in the last couple of weeks and months. Within utilities, while they've removed REC, they've retained NTPC in that top holdings. Now, within the large deletions, which is Reliance and HDFC Bank, it's basically they're looking to add the stocks which can have a bit of a pullback rather than looking at downside support. So that's the reason why they've removed, while they continue to be bullish on those names, they've removed from a tactical point of view. Within the insurance space, they continue to own SBI Life, and within the utilities, they're still retaining L&T as well as NTPC. So these are the few changes that they've done. But to me, I think what they've done is they've added stocks which have recently corrected very sharply, the likes of Adani Ports, the likes of IndusInd Bank, and also something like Bharti Airtel, which has corrected very sharply in the last many weeks.
Absolutely interesting note out there. 11 bottom-up ideas, few additions and a few deletions as well. So that image brings up the outlook for 2025 from Bernstein India portfolio. The list up for you once again on the screen. But speaking about the screen, the Nifty has actually seen a bit of a decline from the highs, down almost 100 points from the highs of today's trading session, and that's led by the Nifty Bank. So perfect time to get you an update coming in from the F&O space itself. Yes, the indices have seen some respite. So if you look at the Nifty Bank and the mid-cap index, compare it to what we saw the same time yesterday, there is some green, but the greens have come off highs as well. The only, positive takeaway for today is that the Nifty Bank, one, is leading the gain, and secondly, it's crossed yesterday's high. So the Nifty Bank, which was making lower highs, has managed to cross yesterday's high. Today's high is 48,806 as against yesterday's high of 48,606. But that hasn't sustained, and as a result of which, the Nifty is unable to cross yesterday's high as well. So the first sign of recovery for our markets are likely to come by only when the Nifty crosses its previous day's high, which is it has failed to cross for the last 9 trading sessions. We've been making lower highs itself. Today's high on the Nifty 23,265 as against yesterday's high of 23,341. There had been some respite for the India VIX as well, which has seen a minor cool off. But from there as well, it's seen a bit of an up move once again, sitting with a cut of just about 0.3 points itself. The mid-cap index is doing a lot better. After a big decline yesterday, the advanced decline ratio tells you that the broader markets are in slightly better health, maybe a bit of a bounce back after the big sell-off that we've seen. But the 23,200 mark, now that seems like a bit of a fulcrum for both the bulls and the bears. We did see a lot of writing at the 23,200 put for a premium of 95 rupees, telling you that 23,100 would be an important support. And were we to break that, 23,000 as a psychological level is important as well. So there too, there are put writers fairly active. The put call ratio, which had fallen to 0.72 yesterday, has come back to 0.87. On the way up, however, 23,200 call writers are equally active. Almost a crore, open interest, crore shares in open interest for a premium of 100 rupees, telling you that 23,300 would be a bit of a resistance. So if you're looking for a range on the Nifty, 23,100 to 23,300 is what the option writers are betting on. 2 individual stocks that I'm pointing out today. Yesterday we had pointed out Aarti Industries entered F&O band. Today the prospect of Angel One entering F&O band are high, and the prospects of Manappuram exiting F&O ban are high as well. So those are the stocks that we'll watch out for.
It's been a very choppy day for Angel One. At one point was down 7%, turned positive, and now is down again 3% after some management commentary that came in on the earnings call. But what are the charts indicating for the benchmark indices? Sachitanand Uttekar of Trade Bulls joins in to answer just that. Sachitanand, good afternoon. Thank you for joining in. How important is that 23,000 mark now for the Nifty? If we go below, or for more importantly, would you call this a bounce which can be used to exit your longs if there are any left, and couple that up with your stock recommendations as well?
Good afternoon, almost. Good afternoon, Mangalam. Clearly, I think there has been a respite, but I think for a firm reversal to develop, the Nifty has to, trend confidently at least above its 5-day exponential moving average, resistance, which is placed somewhere close to around 23,350 as of now. So until unless we don't see a very firm closing on this above this level, the chances of a relief rally look bleak. On the lower side, I would say that 23,000 remains a very important support, at least for this particular week. But there are chances that we may see further slippages going forward towards 22,800. So I think the major trend for the last couple of weeks has been on the lower side. So every respite has been utilized to create some short positions. When we look at the Nifty Bank data as well, today again it made an attempt to reconquer that 5-day exponential moving average resistance, which is placed somewhere close to around 48,880. From that point itself, we have seen some profit booking. So probably there's a chance that Nifty Bank may again revisit that 48,000 mark. So I think both the indices are sell on rise mode. For the Nifty, I think we need a very confident closing above that 23,350 mark to reinitiate some long positions.
Right, take that point. And what about individual stocks?
Mangalam, we have to keep a long-short equation. Even last week, we discussed a short setup in DLF. But right now, if you look at the data set, there's a good, short covering move which unfolded today. We have seen a very strong build-up somewhere close to around 700 mark. So I think the final decline towards 705, 710 would be a good zone wherein some long positions on the contra side can be added in DLF. There's a chance that this short covering may unfold and push the stock back towards 770 levels. So we are recommending buying DLF from here on with a stop loss at 698. It can be accumulated only on a decline up to 710 for our immediate target of around 770. And on the short side, there's a fresh breakdown in Titan. The support at around 3,400 was held very well throughout last week. But if you look at today's data, not only that particular support has been breached, but if you look at the RSI, which was holding above the 50 mark, has slipped below, and the ADX has started trending about the 25 mark, which is again a good strong sign of bearish momentum. So we are expecting that this particular decline that we are seeing in Titan may extend towards 3240 immediately, but a pattern target is placed somewhere close to around 3160, and hence we are recommending fresh short positions in Titan, keeping a stop loss at 3410.
So at the lows of the day now is Titan. Sachitanand, thank you so much for joining in, sharing with us your views on the index and on specific stocks as well. We'll take a short break, continue our coverage on the markets. We also connect with Akash Agarwal, who is the whole-time director of V2 Retail, to discuss their third quarter business updates and a lot more. Stay tuned, back on the other side.
Welcome back. Let's talk about V2 Retail. That's the stock on our radar right now. Remember, over the last 12 months, the stock has surged over 400%, or a 5x return is what we've seen, notwithstanding the muted performance in the stock market that we're seeing right now. Last 12 months, there you have it, nearly 400%. The company has reported a good set of the third quarter business update as well, where the revenue surged 58%, same-store sales growth of 25% as well, much higher than what they've guided for the entire year. The first half was 36%, followed up with 25% in the third quarter as well, which is seasonally strong. Akash Agarwal, who's the whole-time director of the company, joins in now. Akash, thank you so much for joining in. First half, your revenue growth, if we add the third quarter performance to that, the implied 9-month performance is nearly 60% on the top line. If you could give us a sense on what you are expecting for this year on the top line, on SSSG and FY26, if you could give us a guidance as well.
Yeah, hi, thanks for having me. So I think we showed a growth of 59% in the first 9 months of the year. So we are expecting a similar revenue growth number in the coming quarters. And for FY26 as well, we want at least a 50% revenue growth. And when you talk about SSSG, then I think in Q4 of this year, we expect to do about 20 to 25% SSSG. And for next year, our target is a 15% SSSG.
Akash, good afternoon. Thank you for joining in. What are you targeting when it comes to the sales per square feet per month? Because when do you reach that targeted 1250 per square feet per year now? And how many of your stores are currently doing over that 1400 figure? If you could share some number on that.
So yeah, we were at 680 rupees per square feet per month 2 years back. And this year we're going to do upwards of 1000 rupees per square feet per month. And the target of 1200 rupees, I think we should achieve in the next 18 to 24 months. So even if we get an SSSG of above 10% for the next 2 years, we should reach that number. And talking about the number of stores that are above 1200 rupees per square feet, I would say about 45 stores are above that number already.
And what does that do to your margins? Because if revenue per square feet of the store increases with a similar cost, one would assume that the margins are going to be higher. But at the same time, you will have to invest in manpower and new store opening, operating expenses, etc. What does that do to your margins?
So when we move from 1000 rupees to 1200, the pre-Ind AS EBITDA margins should move from about 7% to 9.5%.
What about inventory days, Akash? You had earlier mentioned that you are expecting it to come down by 10 days over the next 2 years. What does the current figure stand at, and do you stick to this, that it will come down by 10 days?
So currently we maintain an inventory level of about 90 to 100 days. And our target is to get it down by 10 days in the next 12 months. So I think we would start seeing some sort of improvement in the inventory days from the next quarter onwards.
All right, because March 2024, your inventory days were at 155. So just wanted clarity on that. What does it stand at right now? 90 to 100 is what you're saying.
So because it's a cyclical business, you have to look at the inventory days, average inventory days of the 4 quarters. So usually the third quarter is the highest revenue quarter, whereas the fourth quarter is a little muted. That is why you see a huge change in inventory days. So when you look at the average inventory days of the 4 quarters, it's around 90 to 100 days.
Right. Let's talk about things that concern shareholders. I'm looking at a couple of data points here, and that tells you that for a company that has seen such phenomenal returns, over 5,000 crore in market cap, such bright prospects like you're talking about 50% plus sort of revenue growth, there is not major institutional shareholding. I mean, it was just 2 quarters ago that you had, Motilal Oswal buy about 4.88% stake in the company. Why is it that institutions haven't, taken some of the stock? Because on the other side, the people who are buying the stock, the number of public shareholders from last December to now have increased from 16,000 to close to around 27,000. The state would get a lot more confidence if major funds, etc., who are bullish on the retail space, participate in your stock as well. Why is it that that's not happened?
So we want to focus on our performance, and we want to focus on the good numbers that we've been delivering. We don't know the complete thought process that goes behind these institutions and, getting into a stock. But we have seen a lot of interest from a lot of institutions, and we have been in touch with a lot of them. But I think it also depends on the overall macro picture, the overall state of the market. So I think, we just have to focus on performing as well as we have been performing. And I think it should convert in the near future.
Just to finish that point, Akash, have you met any institutions in the recent past? If you could shed some light on that. And part 2 of my question is, what is the what are the cash on the books currently, and what is the operating cash flow that you are currently generating?
So we do an investor conference every quarter. So we held a conference, I think 2 months back, and we met about 30 to 40 different kind of investors. And we saw a lot of interest also. And talking about cash flows, the growth that I'm talking about and the 100 stores that we want to add in the next financial year, we've already added 48 stores this year. And in the 3 months that are left, we're going to add another 25. So that's about 125 more stores in the next 14 months. So that will all be funded through internal accruals. And it will all be funded through the cash flows that we generate internally.
No, another concern, I'm looking at your annual report right now, and if you could give us some clarity on this. What proportion of the purchases you make are done from related parties? Because there's this entity called V2 Smart Manufacturing Private Limited. In FY24, purchase of traded goods against advance payments was close to 190 crores. The advance that you made for, purchase of traded goods was close to 206 crores. Again, the advance against purchase of traded goods was close to around 28.7 crores. So net, or rather gross value of close to 500 crores, which is almost as much as, your first half's revenue. If you could give us a sense on what your purchase policy from related parties is.
So it is a 100% wholly owned subsidiary of V2 Retail. So it has the 3 manufacturing units that we own. So about 20% of what we sell, we manufacture in our own manufacturing units. So that is the sales that you're talking about. So we save about 10% cost in those goods that we manufacture in our factories, and we pass on the complete benefit to the consumers. That is why we get such a competitive advantage in terms of price.
And no purchases made from unlisted, unwholly owned subsidiaries, which are still perhaps owned by related parties? There is none of that?
No.
So do you expect that number to remain as it is right now, Akash, or do you see an increase in that number?
No, that number will decrease because we are not opening any more manufacturing units. And as our volume increases, the capacity remains constant. So basically that 20% will come down to 15%, and next year I think should be less than 10%.
Right. Just a final question before we let you go. You did say that there would be rising contribution of in-house designing and private labels. If you could give us what the number is right now and what you're targeting it to be. And you are getting 90% of your revenue from apparel. Over the last 2 years or so, what we've seen is also a big trend of large conglomerates doing value fashion and going into the same areas as you are. There is Zudio, there is Ustar, there are others as well who have come up with those value fashion options. How do you tackle this competition?
So India is a big enough market to have multiple big players operating in different price segments. So the models that you mentioned are at a slightly higher average selling price than us. So we operate at a 300 rupees average selling price level, whereas Youthstar and Zudios, the likes of them, operate at around 500 to 550. So it's a different class of customer, but in each price segment, there is enough space for 4 or 5 big national players to actually operate, because still more than like 75% is unorganized retail. So the shift from unorganized to organized has accelerated, and it'll keep on happening in the next, decade. So retail, especially value fashion retail, is poised to grow at more than 13-14% CAGR over the next 5 to 10 years.
Indeed, we leave it at that. Akash, thank you so much for joining in and sharing with us your views on the road ahead for the company. Wish you good luck for the quarters ahead as well. The management of V2 Retail, the stock currently trading 1% lower, but has been an outperformer over the last 12 months. Time to take a short break. The Nifty still remains 100 points higher. Continue our coverage of the markets on the other side. Stay tuned. Welcome back. Now, the Finance Minister, Nirmala Sitharaman, will present NDA 3.0's first full-year budget on the 1st of February. Now, India Inc. wants a higher capex allocation along with incentives to boost India's consumption appetite. Now, we spoke to the top industry leaders at CNBC-TV18's budget town hall, and here is their wish list for the Finance Minister.
Right now, the rebate starts from 7 lakhs. So I think if they can take that up to 8 lakhs, I think that will provide some relief to people. And the maximum, at least slab rates, 30% rate kicks in from, say, I think 20 lakhs of income, from 15 lakhs of income. If that can be accelerated to, 18 lakhs, 20 lakhs, and likewise, you trickle it down. And maybe you can cap it at a certain level so that people in the higher income brackets may not, of that a certain level don't get that full relief. But if you provide that, I think that will provide a tremendous spurt in consumption. I think the lower and middle income people do deserve it.
Manufacturing depends much on the consumption by various sectors. And if you really look at what are the positive tailwinds which you're seeing, the tailwinds are coming basically from rural demand, which we think will pick up going forward. But if you look at the headwinds we are facing, it's basically the global uncertainty, the high real interest rate, and there are currency pressures which will be on this. So our real understanding of continuing to boost manufacturing would be to focus on policy reforms and continue to ensure the ease of doing business is further, we address that.
We've also spoken about coupons or vouchers which can be given for consumption, especially to the lower income earners. And we can direct it specifically in areas which are good for them and good for the economy. I think that's one way in which you could enhance consumption and direct it for the social good as well.
Is consumption demand, and seeing how consumption demand is boosted through better income tax cuts, and say, for instance, cut even on the excise on fuel and stuff like that. The third, I would think capex and in focus, the greater focus, 25% over last year on would be important. It's important for us to keep doing that year on year. It is picking up space, but I would think that it is important that the focus on the government heavy lifting helps the private sector to come in a big way. And if you've seen certain countries, I mean, they've gone in for decades of heavy lifting.
Right, with that, we'll slip into a short break, come back on the other side. Our special segment, Quarter Say, Quarter Duck, we bring you earnings expectations coming in from the banking sector. Also keep an eye out on NALCO, as the bottom of your screen suggests that there has been a sharp fall in alumina futures. Prices are down 3%. Remember, NALCO gets a lot of their revenue from alumina. We'll keep an eye out on that stock, which is currently holding with a gain of almost 3%. The market's trying to stage a bit of an up move once again, but you know what's at the bottom of your screen, dollar rupee holds the key to where it goes from here on. The Nifty Bank, though, is still up almost 600 points. When he started the show, it was up just about 450 odd points. So trying to move higher. The Nifty too inching closer to that 23,200 mark, which is the fulcrum. Speaking about the Nifty Bank, let's get you what the street is expecting from the banking space itself in the third quarter. We've got a lot of quarterly updates from the entire financial space. Abhishek's put all of them together to give us an update on what the expectations would be in our special segment, Quarter Say, Quarter Duck.
To begin with, deposit growth on a year-on-year basis was at 9.9% at the end of Q3 FY25 and about 2.6% on a sequential basis. So YOY, the deposit growth is the lowest that you are seeing since March of 2023 as per RBI data. Advances growth was about 11.2% YOY and 3.6% sequentially. So loan growth has outpaced the deposit growth this time around, as RBI has brought down the cash reserve ratio requirement for the banking sector in the previous MPC meeting. Hence, you saw the loan growth outpacing deposit growth this time by the end of Q3 FY25. Now, credit deposit ratio for the industry is at all-time high of about 80.5%, reflecting a more aggressive lending stance by the banking sector. Now, this augurs well in a high interest rate scenario for some lenders to maintain their net interest margin at healthy levels if at all they are able to curtail or contain their slippages. Now, net interest margin is expected to remain largely unaffected for most of the large lenders. We may see marginal decline for some of the lenders who have been aggressive on deposit growth, and net interest margin will also get impacted for lenders with higher slippages in Q3 FY25. Now, the net interest income growth over here is expected to be sluggish, particularly for PSU banks. So PSU banks have largely raised deposit rates at high cost, while their loan growth is lower than the industry levels. On credit costs, certain sectors, especially those with unsecured lending like personal loans, credit card loans, as well as microfinance, they are expected to face higher credit costs in Q3 FY25. Now, this could be as a result of higher defaults and hence incrementally increased provisioning requirement for Q3 FY25. There is a need for more evidence to confirm whether these higher credit costs are stabilizing or not. Now, with respect to earnings outlook, overall earnings are expected to remain weak for the banking sector, particularly for PSU banks, because largely the treasury gains that they have had in the previous quarter will be missing this time. For some lenders, higher credit costs can impact their earnings momentum as well. Overall, earnings are expected to see weak momentum for the banking sector in Q3 FY25. Now, asset quality, while it may be generally stable for large players, concerns remain around the unsecured lending portfolios, which are expected to see continued deterioration like they did in the previous 2 quarters. X of unsecured loans, asset quality is largely expected to remain under control or see marginal improvement for the banking sector. We have some of the key estimates coming in from Kotak Securities. For SDFC Bank, they estimate NII growth of about 9% YOY, and for PAT, they estimate it to be at 16,591 crore, which is up 1% on a YOY basis. For ICICI Bank, the NII is expected to be up 9% YOY and profit is expected to be up 14% YOY. For Axis Bank, the NII is expected to grow at 10% YOY, but profit to be up only 3% YOY. For SBI, the NII is expected to be up 6% YOY and profit is expected to be up 59% YOY, but a decline of 21% nearly on a sequential basis. For Bank of Baroda, Kotak Securities estimates NII growth of 7% YOY, while profits are expected to decline by 13% on a YOY basis. Back to you.
Abhishek, thanks a lot for that. All eyes will be on how these banks fare in the quarter gone by in terms of the other parameters as well. But with that, it's a wrap on this edition of Halftime Report. We leave you with a choppy but in the green Nifty from Mangalam, me and the team that put this show together. Thank you so much for watching Business Lunch for the next 30 minutes.